Dear viewers, in a recent video, I shared with you how AI is disrupting the business model of traditional software firms and how few niche players in the small caps could ride AI instead. You can find the link below this video. That said, for all that could go wrong with the traditional IT companies, much of this pessimism is already visible in the valuations. The BSE IT index is down 23% till date versus 11.7% correction in the Sensex. It has officially entered a bear market. We must reassess valuations and earnings power for leading IT companies for sure. However, there is going to be a point when concerns are overdone and when the price offers enough margin of safety and potential upside in the stocks. So how big is the risk here? And at what point does the price turn attractive for IT stocks? Let us first understand what AI is doing to enterprise tech budget that gets allocated to IT companies. Here is what I gathered from the recent earnings call of a leading IT service firm. 40% of the existing opportunity that focuses on areas like app development and support or traditional infra operations and customer support is getting actively disrupted. Think of this as old school economy of IT services that is getting automated away. In a few years, it is likely to come down to 25% of IT spend. For 55% of the opportunity, AI is less of a destroyer and more of an enabler. Businesses in cloud, cybersecurity, data analytics, and digital platforms can use AI to deliver faster and better outcomes for clients. This part is expected to grow in double digits, gradually increasing its relative importance in the enterprise spending and will keep IT companies relevant. The remaining 5% focuses on core infra for AI era, AI factories, advanced AI engineering, custom silicon, and next generation AI platforms. Expected to grow at 30% CAGR, it is likely to become 20% of the market in 5 years. So while there is a part that is at risk with the surge of AI, new pools of revenues are emerging as well for IT companies. Now do note that not all the slowdown in the number and softness in the guidance of traditional IT companies is on account of AI. With the ongoing West Asia situation, global clients are revisiting their tech budgets. This is temporary and not a structural issue in my view. And then there is a specific event in a leading IT firm that gives me hope and that led me to ponder over the emergence of value in the IT companies. I'm referring to HCL Tech. To be sure, at 4%, the contribution of AI to its revenue is quite low. However, the management in its recent call has stated that they aim to grow AI native services in the 25% to 30% range. That shift and intent matters. If you look at the recent deal win announcements and business collaborations, they are unmistakably AI focused. But it is not these announcements that make a compelling proposition for me. It is where the HCL Tech promoters are putting their money in. You see, the promoters in HCL Tech have been consistently purchasing the stock from the open market since Feb 2026. Promoters have bought over Rs 2 billion worth of shares from the open market at an average price of Rs 1309 per share and in the price range of 1134 to 1454. For the first time since March 2023, the promoter stake has gone up from 60.82% to 60.86% in March 2026. With buying spree in the recent months, it is likely to be even higher for the June quarter. It is often at the times of fear that a real opportunity emerges in investing. The management action suggests that HCL Tech could be at that point. The stock is down 32% in less than 4 months, and at current price, it offers a dividend yield of 4.5%. On top of it, it is trading at a price closer to the range in which the management has bought the stock from the open market. Now do note that the management buying alone does not guarantee anything. It does not eliminate the risks around AI disruption, but it does raise an important possibility. What if the market is underestimating the relevance of HCL Tech and its ability to adapt and participate in the next wave of enterprise tech spending? History shows that extreme investor pessimism often lays the foundation of strong returns. Perhaps Indian IT is entering that phase now, and perhaps the obituaries being written for companies like HCL Tech are a little premature, maybe even preposterous. What do you think? Share your feedback in the comment section. Thank you for watching. Goodbye.